Good afternoon, everybody. This is the weekly wrap up for January 21st, 2022. It's a Friday. Hope everyone's having a blessed day out there. We've got more snow here in Colorado. I'm staring out at my front yard, and it's been snowing since, I guess, about 11 o'clock this morning, Mountain Time. So I don't think it's going to snow a lot. So I probably just have a snow pusher and a shovel in my future. So, no snowblower, which if you've never used a snowblower, it's not the most fun thing to do in the world. You smell like you've been mowing the grass for a couple of hours when you're done because of just all the exhaust, and you're usually sweating your balls off or sweating your whatever off, and just because you got all you're bundled up like Randy from A Christmas Story, and you go out and it's cold outside. It's 20 or 10 degrees, and you go out there, you're all bundled up, and after about 10-20 minutes you're sweating because you got all these clothes on, and you're manipulating this giant monster of a snowblower around. Anyways, you didn't tune in to hear my snow stories, so if it's your first time watching, be sure to hit that subscribe button, click, and be sure to like and share with friends and family. I would greatly appreciate it. And let's go ahead and jump into how the market did today. Not a very good day in the market. So let me go ahead and there we go. All right. Today, the Dow Jones closed down 1.3% to 34,265. The S&P 500 closed down 1.89% to 4,397. NASDAQ looks like it was the worst. It came in down 2.72% today to close at 768. The VIX was up another 12.74%, closed at 2885. So, well, that's what it's at right now. I guess the VIX runs constantly. Across Europe, lots of red, most of them over 1%. And same thing across most of Asia. The only thing I see up was the Hang Seng, and it was up 0.05%. So, yeah, it's pretty much a terrible day in the market. Let's go ahead and take a look and see how the indexes did for the week. All right. The Dow Jones appears to have been down about 3.89%. The S&P 500 this week, granted it was a short week, was down about 5.05%. NASDAQ down about 6.09%. Dow Transports down about 3.5%, and the Dow Utilities looks like it was the only one that wasn't terrible this week. It was down 0.68. So across the board, or at least domestically, it looks pretty rough. Let's just grab one of our international space and see how it did. International, what is this? High dividend yield ETF down about 1.6. Other international developed markets down about 2.25. Global was down 3.34. So yeah, even across looks like across the board, we did not have a very good market. So okay, well, let's take a look at the jobless claims for this week. We talked about it yesterday in one of the articles I reviewed. We came in at 286,000 initial jobless claims against a forecast of 220. Last week's numbers were revised up from 230 to 231,000. So it looks like the last 3 weeks have come in above forecast. So we did have the last week of December. The numbers were under 200,000, but the last 3 weeks we've slowly been creeping up. So not ideal on the job market front, at least from the initial jobless claims. Continuing jobless claims came in at 1,635,000 against a forecast of 1.58 million. Looks like we've been creeping up. Last week's numbers were revised down from 1.559 to 1.551. Still, and that was below forecast. So looking across the last month or two, it is still pretty good. It has crept up a little bit this last week. as far as continuing claims. But and again, these are lagging indicators. So it's, most of the time businesses, if they're letting go of people or people are leaving the workforce, the business already knows, hey, profitability is down. We got to shed some people out of our employment. But anyways. Okay, housing starts. That was one of the data that came out this week on Wednesday. Housing starts came in at 1.702 million against a forecast of 1.65 million. So, looking at the strength of the housing market, looks still fairly good. We had an up month from last month, and we're coming in at above forecast. So I see that as pretty good. All right, the United States leading index of economic indicators came in at 0.8, right on forecast, which was 0.8. Previous month was revised down from 1.1% down to 0.7. So that takes it below the forecast for last month. But again, looks fairly steady right now. So we'll chalk that up as a win. All right, the Baker Hughes rig count, we're down one from last week. We're at 491. Last week's number was 492. We have seen a bit of a stall in the increase in rigs pumping oil for us. From October, October 1st, we were at 428. Now we're at 491. So again, significant increase. But if you look at the chart, we were, heading into the pandemic, we were at about 680, 670. So we're still about 160, 170 rigs from being back at capacity where we were when all this started. Okay, well, I have 3 articles I want to breeze through. This first one is called No Salt Deal. Democrats vow to block the Build Back Better bill without a tax break. This is written by Jarrett Renshaw from Reuters. Let's go ahead and dive into this. Several U.S. House members from President Joe Biden's Democratic Party are threatening to block a renewed push for his Build Back Better bill if it does not include the expansion of the federal deduction for taxes paid to state and local entities. Expanding the deduction, known as SALT for state and local taxes, has been a demand for lawmakers in high-tax states such as California, New Jersey, New York, especially in suburbs where Democrats seek to retain control in the November 8 elections. We would support the president's agenda, and if there were any other efforts that included change in the income code or in the tax code, then a SALT fix must be part of it. No SALT, no deal. Members Tim Souza of New York and Mike Sherrill and Josh Gottheimer, both of New Jersey, said in a joint statement late on Thursday. The SALT deduction, part of the U.S. Income tax code from its inception more than a century ago, was restricted to $10,000 in a 2017 Republican tax law. I didn't know that laws were specifically Republican or Democrat. The cap disproportionately affects homeowners in higher home value states that lean toward the Democratic Party, like New Jersey, where the average homeowner pays roughly $9,000 in local property taxes. Asked about the House lawmakers' demand, a Biden White House official said, "We are in touch with a wide range of lawmakers regarding the president's economic growth plan for the middle class and weighed in about SALT late last year, but we won't negotiate in public." The SALT caucus has more than 30 members in the House of Representatives who want to expand the deduction, including some Republicans. Congressional aides say their demand adds to the challenge for the White House faces as it tries to salvage some of Biden's $1.7 trillion spending package and push it through with slim congressional majorities. As the White House tries to downsize the bill, it may need to jettison hundreds of billions of dollars in special programs, but preserve SALT, a deduction that some in the party call a giveaway to the rich. House Speaker Nancy Pelosi can only afford 3 defections because Democrats narrowly control the majority in the 435-member House. The House passed a version of Biden's special spending bill that increased the cap to $80,000, despite some objections for some progressives that it largely benefits higher income households. The bill died in the 100-member Senate for lack of majority Democrat support. So, yeah, this, the SALT deduction, quite frankly, would benefit me tremendously. I mean, we pay Well, actually, I pay a lot less property taxes here in Colorado than I did in living in Houston. The property taxes in Houston are quite high, especially due to the school taxes, especially if you live in the outer suburbs, where I did down in Clear Lake, next to NASA. The property taxes ran us about 3.5% of our home value, and the bulk of that was for the school district. So, I mean, up here, shoot, I think I pay about 0.5% of my home value. So again, much, much lower. Granted, the home I live in today is a little more expensive, but still I come out, on the a much better end of taxes in the long run. So, I mean, because my house in Houston was like 200 something thousand. This one was twice that when we bought it. Now it's like double that. But it's while it would benefit me, I just don't see it as being right because the way the SALT deduction works. Let's say you owe. Take my wife and I for example. Our tax bill to the Treasury usually runs about 60K. As of the last couple of years. So if we had, I don't know, $30,000 in property taxes, income taxes, everything else here in the state, we would deduct that from our tax bill to the U.S. Treasury. So I get it. You want to try and help out folks who are paying a lot in income taxes, but the problem is that for folks who don't get that deduction, they're paying 100% of their taxes into the U.S. Treasury, while the tax bill for someone in a higher income range, they're paying a much lower percentage into the federal Treasury because they're getting a deduction for what they're paying locally. So I see both sides of the argument. It's while it would benefit me more to get the SALT deduction, in the bigger picture, to me, it just doesn't seem like it's a fair deal to, especially those in the, kind of middle income, where, they're paying, and also in states where you're not getting, where you don't have high taxes, all your tax bills go into the federal Treasury. So I personally would rather see my taxes go locally to my county and to my state. Because living here in Colorado, I see where my taxes go. They go to nice trails. The roads are excellent here. Well, for the most part. I mean, we do get a lot of snow, and there's the construction season is kind of squished down due to the weather here. But the roads are fantastic. They keep them plowed most of the time. Granted, I live out in the sticks, so the plow trucks don't always get out here. So that's why I drive a tank. So, all right, well, let's go ahead and jump into the next article. Godfather of technical analysis says the stock market could fall 20% or more, but don't panic. This market really did unbelievable for 18 months. All right. This was written by Mark DeCambry. This comes from Market Watch. Prominent market technician Ralph Acampora says the recent bout of market volatility has him uneasy, and now he's forecasting a deep drop in the market that has already delivered significant bruising to Wall Street in the first few weeks of 2022. I really didn't like yesterday's action. That wasn't cool, said Acampora in an interview with Market Watch late Friday morning from his residence in Minnesota, referring to the intraday reversal on Thursday when the NASDAQ composite was up 2.1% at its peak, only to end down 1.3%. It was a second such reversal for the NASDAQ. The folks at Bespoke Investment Group said that Thursday's backslide marked the first time the NASDAQ composite erased an intraday gain of 1% and closed lower by 1% to on back-to-back days in over 20 years. It's not climate activity, it's a reversal pattern, says Acampora. Acampora, who began his career on Wall Street in 1967, said that recent pullbacks are bearish for the outlook in stocks. I've lived through too many bear markets, he said via phone, noting that the lengthy bullish run for stocks, which has been primarily fueled by easy money policies from the Federal Reserve to combat COVID, may be coming to a conclusion. If we're honest with ourselves, this market really did unbelievable things in the last year and a half. Markets have been unsettled since November, and fears about a Federal Reserve that will be aggressive in its current battle with rising inflation, stemming from supply chain bottlenecks and increased demand as COVID fears take a back seat to consumerism, appearing to culminate on Wednesday with the NASDAQ composite entering correction for the first time since March and crossing below the long-term trend, its 20-day moving average for the first time in nearly 2 years within days of each other. Many chartists refer to Akampora affectionately as the godfather of technical analysis, a pioneer in the field of price chart based trading. Akampora says he has mostly advised clients to be cautious. He told Market Watch on Friday that his own sentiment has shifted towards, if you had spoken to me on Tuesday, I would have said that the market is going to correct a decline of at least 10%. And now I'm talking more 20% or more. He said his expectations for declines in stock benchmarks. What has changed for Akampora besides the unsavory intraday action? He says that signs that bullish appetite is waning is one reason, and that includes the decline in Bitcoin, which he says isn't an asset that he's a fan of because, but does gauge it as a good sign of investor attitudes. He says Bitcoin sentiment has also aligned with technology, suggesting that those assets are moving more in tandem. The Nasdaq's breakdown technology is going to pull us down, and Bitcoin below 40,000 is a significant breakdown for sentiment, Akampora said. The market technician also said that he poured over a number of components of the Dow Jones Industrial Average, including American Express, Goldman Sachs, JP Morgan, and Honeywell, and spotted negative weekly chart patterns. So I'm a little concerned, he said. Now we're talking a bear phase. That said, the analyst said that investors shouldn't feel too sorry for themselves. Come on, he said, we've had a phenomenal market every other day. We're looking for all-time highs. In the new regime, however, Akampora said, don't expect any near-term records. I just don't see new highs anytime soon. What should investors be looking for to determine when to wade into the market with more gusto? Akampora said he would look for the CBO Volatility Index, also known as the VIX for its ticker symbol, rise to 38 or 40 before the market can be said to be bottoming. The VIX itself, which uses the S&P 500 options to measure trader expectations for volatility over the coming 30-day period, tends to rise as stocks fall and is often therefore a referred guide to the level of investor fear. Its historical ranges between 19 and 20, and it was trading around 27 on Friday, up 40% for the week. One of Akampora's other concerns is that the economy faces stagflation, a period of rising interest rates and rising inflation. Stagflation can cause real incomes to stagnate or decline and erode purchasing power. Such a scenario would be a years-long dampener on the market's uptrend. He would advise investors to wait for a bottoming pattern, a process of the market putting in higher lows and higher highs before seeing the downturn as a buying opportunity. All the wild moves in the markets of late will make for fodder for Akampora, who is painting a massive chart for the Dow on the side of his Minnesota barn, which he continues to update. The octogenarian also said he's now planning to write a book on his history of financial markets that offers context and insights to those who may be new to the markets and the economy. Other men collect garbage. I collect history, he said. So interesting. Yeah, I've been saying for quite a while that, the last 2 years have really just staved off a market downturn. We were beginning to see it at the beginning of the pandemic back in, I guess, February, March. The market, from late 2019 through the first quarter of that year was, in my opinion, trending in a negative direction. And then, we had COVID and, the market collapsed. And then we had the Fed rush in with, wheelbarrows full of cash. And then we saw this giant rally. So all we did, in my opinion, was just push that out 2 years. And at some point, we're going to go through that next, market cycle. I don't have a crystal ball. I don't know exactly when that's going to be. I trust my looking at the technical analysis to give me an idea. Is this just a short-term blip or is this more of a long-term situation? Okay. Last article has to do with Social Security. I figure with the number of older clients that I have, this is certainly a good primer. Should I claim? It's titled "Should I Claim Social Security at age 70 or take it earlier and invest the money?" Written by Harriet Edelson. Okay. All right. Few things are certain, yet Social Security retirement benefits are among the safest sources of retirement income for now. Inflation-adjusted monthly benefits backed by the federal government for as long as you live, assuming the federal government's still there. Sounds good, doesn't it? Yet the majority of Americans claim their lifetime benefits before it reaches its highest amount, while just 5 to 6% wait until they are 70 years old. Is it better to wait until you are 70 or claim a little earlier and invest the money? Planning is the surest way to make the right decision for you, yet many forego mapping out the strategy or a strategy that can make a difference between some guaranteed income and the vagaries of the equities market. The earliest you can claim Social Security is 62. You can claim as much as 30% more by waiting until your full retirement age. For those born from 43 to 54, full retirement age is 66. For those born after 1954, full retirement age increases incrementally by 2 months until it reaches 67 for those born after 1960. Those who wait until 70 to claim their benefits, those who wait until 70 to claim receive what are known as delayed retirement credits for each month they waited past their full retirement age. When you wait a year, your monthly payment goes up by 8%, says Roger Young, Senior Retirement Insights Manager. However, it doesn't mean you're getting an 8% return on your money. Waiting to claim is not for everyone. Those who need the money to cover their monthly expenses are in a different position. The number one thing is, do you have the cash you need today? That's what really dominates your decision about when to claim, said Daniel Lee, Director of Financial Planning and Advice at Bright Plan, a financial wellness benefit provider based in San Jose. Others who have an illness or a condition that may shorten their lifespan may want to claim earlier or as early as 62. Yet others can plan ahead so that they have at least an adequate cash flow that allows them to postpone until claiming until 70. What about those who want to claim Social Security benefits earlier so they can invest the money? Experts caution against this strategy. Think of Social Security as insurance rather than an investment, says T. Rowe Price. Price is Young. Money to help you make sure you don't run out. Think about your life expectancy. If you claim earlier, you're trading guaranteed lifetime payouts with COLA, cost of living adjustments, a government program for the volatility of potential profits, said certified financial planner Britt Nazier. Let's see. Claiming early to invest the money is a risky strategy, Lee says, just because the equity markets have performed well during the past few years, except for March of 2020's precipitous drop during the early days of the pandemic, doesn't mean that trend will continue. Capital markets appear poised to enter a new era of lower expected returns, according to T. Rowe Price U.S. 2022 Retirement Market Outlook. Retirement savers and retirees will need to plan and adjust accordingly. In contrast, Social Security benefits, especially for those close to retirement, are likely to be there, even if Congress hasn't yet passed legislation to shore up Social Security Administration's long-term sources of funding. Experts say it's a guaranteed stream of income. Lee says it's a good way to diversify your portfolio. If you permanently reduce the amount of money, monthly income you get from Social Security retirement benefits, you're concentrating your efforts in the stock market, Lee says. Social Security is a good diversifier and source of income. Some believe they can earn higher returns by investing the money they claim earlier than 70. While portfolios could produce higher returns, it is unwise to count on it, especially this close to retirement, writes economist Wade Pfau. Certainly, those who have considerable savings, if they feel they will not be dependent on Social Security benefits in the years ahead, may be inclined to taking more risk in the equity market. They may choose to claim earlier and invest the funds at a more moderate risk. One reason some will choose to claim earlier than 70, Lee says, if it can add a good experience to your life that might not otherwise be able to enjoy. Here are some ways to create a bridge that allows you to wait longer to claim. Consider claiming a claiming strategy for couples. If you're a married couple, the lower income earner claims first, at least waiting until full retirement age. That's the bridge, Nizer says. The higher income earner waits until age 70. When either spouse dies, the surviving spouse will receive the higher amount of Social Security. Withdraw funds from your 401k. Everyone won't feel comfortable withdrawing funds after saving for many years, yet it can be a bridge to later Social Security claiming. It would be Necessary to withdraw more until Social Security starts, writes Fowl, but retirees can then withdraw less after starting Social Security. The strategy is not foolproof, he notes, because if a portfolio drops in value early in retirement, it can lock in those losses. Use funds from cash allocation. If you have cash stashed in your 401k plan, you can use that money so you won't have to sell equities that may be at a low point, Nizer says. You won't have to worry about a downturn in the market. Alternatively, if you have a large rainy day emergency funds of 2 years of living expenses, for example, consider spending from there. We would sell from stocks and bonds and replenish their emergency fund if they use that cash, while delaying claiming Social Security, he says. Send dividends to your checking account. Rather than having all the dividends reinvested, consider having some dividends linked directly to your checking account. Dividends are very helpful, Nizer says. In taxable accounts, you can elect not to reinvest dividends. For example, if you need funds to pay quarterly estimated taxes, dividends as well as capital gains can be sources. However, some companies have suspended or cut dividends during the pandemic. Claim a pension from a previous shorter-term job. If you worked for multiple employers during your career, some may have offered you a micro pension based on a shorter-term work. Nizer says this can be used in combination with other approaches discussed. Get a part-time job. Engage in some part-time work, Nizer says, as well as using a combination of other strategies described above. All right. So, with Social Security, when I'm running a financial analysis, I'll typically run several different scenarios. I mean, the software will provide, in its opinion, what is the most profitable or where you get the most money. In the old days, I used to break out a spreadsheet and put in all the years and then show the break-even points from where if you took it early or if you took it later, where your break-even points were. If you thought you had going to live into your 90s, maybe waiting made more sense because you would make more money by the larger payment long term. If you're a sickly person, you think, hey, I'm not going to live very long. Maybe it made more sense to claim early, and so it really varies. I mean, most things with financial planning really have to center around the individual. So that's the real tough part about it. So, all right. Well, that's everything I had for this Friday. If there's something that I didn't cover and you'd like me to talk about, feel free to shoot me an email with the subject, or feel free to give me a call. I'll be here most of the afternoon. So, hope everyone has a fantastic weekend, and I'll be back on Monday with the weekly economic update. And y'all take care. Bye bye.